Well, first of all, I want to thank Andrea for giving us this time today. She's a very busy person, so we really appreciate her time in this insightful topic, such an international tax. And I want to thank everyone to being in time today. I hope everybody's having a happy Tuesday so far. My name is Barbara Gomez. I am the Assistant Director of the Office of Graduate in International Programs at the University of San Diego School of Law. I oversee admissions and recruitment for graduate programs. Um, and I'm very happy to be introducing this webinar for everyone today. I'm gonna go ahead and introduce our wonderful guest speaker today, but before I do that, I want to make sure that I relate that I want to ask to please keep your microphone on mute to avoid any disruptions throughout the webinar. And if you have any questions, you can put them in the chat and we will do our best to address them at the end of the meeting. Andrea Cisneros Valdez is an international tax attorney, educator, and cross-border tax advisor with more than 15 years of experience in U.S. and international taxation. She serves as a senior tax consultant at Raymond James, where she advises on tax reporting, withholding, FATCA compliance, information reporting, and operational tax matters impacting a large financial institution. In addition to her work in the financial services industry, Andrea is of counsel at USD Law, where she advises multinational businesses, entrepreneurs, and high net worth individuals on international tax planning, cross-border transaction, tax compliance, tax controversy matters. Her practice focuses on helping clients navigate the complexities of global taxation while maintaining practical and efficient solutions. Andrea is also an adjunct professor at the University of San Diego School of Law, where she teaches legal research and writing to our LLM students. She's passionate about mentoring international attorneys and helping future legal professionals develop the analytical and writing skills necessary to succeed in the U.S. system. One of the most rewarding aspects of her academic career has been inspiring students to pursue advanced legal education and professional growth. Originally from Mexico City, Andrea brings a unique binational perspective to her work. Before moving to the United States, she practiced tax law in Mexico and advised multinational clients on cross-border matters involving both U.S. and Mexican tax systems. Today, she remains actively involved in the international tax community through speaking engagements, professional organizations, and collaboration with tax professionals across multiple jurisdictions. Andrea earned her LLM in comparative law with a concentration in taxation from USD School of Law and her law degree from Universidad de las Américas Puebla in Mexico. She is licensed to practice law in California and Mexico and is fluent in English and Spanish. Through her work as an attorney, professor, and advisor, Andrea is committed to helping clients, students, and colleagues navigate complex challenges while making a meaningful impact in her community. So as you can see, we have a wonderful guest speaker today. So Andrea, you can go ahead and begin with this topic.
Barbara, thank you for the kind introduction and the invitation to be part of this webinar series. I see a lot of familiar faces here. Some of you, I'm going to have them for 3 hours today. So I guess that I'm not that as bad of a professor, otherwise you wouldn't be joining me an hour earlier than our class. That makes me happy. And I see my past students and other people, which makes me really happy. I don't want to talk a lot about myself, but international tax is an area that it's huge. I don't think that there's like, okay, a start point and an end point, because it involves so many aspects, scenarios, countries, etc., that there's no end to international tax, right? It's not like, oh, US tax, period. You have an IRC code, an internal revenue code, and that's it. It's something that probably never ends, that it's evolving constantly, that sometimes is also about politics, about geopolitics also. It's, I mean, you know, tariffs. They were part of strategy this year, last year. So it's just something, tariffs is also part of the tax world. So I want to talk about international tax from my perspective and how is my practice? What do I see in my practice? As Barbara said, I am a senior tax counsel at Raymond James. It's a financial institution that holds $1.83 trillion of assets under management. So we generate a quite bit of income with those $1.83 trillion. And I am the responsible in the whole financial institution of making sure that we're compliant with tax laws, that the income that is being generated it's being reported, it's paying the rates that should be paying, that we're issuing the correct forms to the taxpayers, our clients, and also to the IRS. Also, I'm partner of counsel at a local law firm here in San Diego. So I have like two different perspectives, right? I have the perspective from the financial institution, and I have the perspective from being a partner at a law firm. So, said that, what I want to do today is I'm going to give you, without like a lot of technicism, but like more of trying to introduce you to international tax or to my world of international tax, I'm going to give you the 5 main rules that I work with in my practice. All right. And like how they affect taxpayers and how might they affect someone that you know. I'm going to start sharing my screen. Okay, and I don't want to give you like the rules and be boring about like tax rules. I'm just gonna tell you the rules in a very simple way, as little surprises. So I'm gonna call them the 5 surprises. Uh, this is what I wanna hear. Okay. Okay, also, I do work with a lot of attorneys. I work internally with Raymond James, like with all the counsel, the legal department. At RJS Law, we're a tax law firm. But even though we're a tax law firm, I am the one who leads the international tax department. And not even my colleagues are tax attorneys or do controversy might know about these rules. So these rules is just like, they're like really only focused on international tax, not on tax itself. Okay, so how do you think a country will tax foreign taxpayers? Usually through withholding. So what that means is that when you have a US payer that is paying to a foreign person, the way that the US will tax that income is making the US payer withhold, report, and pay those taxes to the IRS. And that makes sense if you think about it, because otherwise, how the US will go after someone who does not live in the US and is not a US citizen. So that's why it imposes the obligation to the payer of receiving or keeping, or the correct word is withholding, the portion of the taxes that this foreign person should be paying. Okay, so that means that collection occurs before payment. So before I pay to the foreign person, I am going to collect the tax. I am going to withhold it. I'm not going to pay that foreign person until I have collected the portion of the taxes. Now, what does that mean in my practice with Raymond James? It means like we have clients are foreign governments, foreign institutions, foreign companies, and they come and let's say they buy shares of a US company. Usually it's not like that because there's other rules, but let's just make it easy. And for practical purposes, I'm just going to say that they buy shares of Apple. And once that, or Qualcomm pays dividends, for example, they buy shares of Qualcomm, and Qualcomm pays dividends quarterly. So when Qualcomm pays the dividends, it pays the dividends to Raymond James, and with Raymond James, we hold a portion of the taxes that other foreign person would need to pay to the IRS, and we send it to the IRS, we send a form to the IRS, and we also send a form to the taxpayer letting them know we had withheld this amount, your income of dividends was this amount, we withheld this other amount, so your actual proceeds is this other amount. So that means that financial institutions become tax gatekeepers, right? That doesn't mean that it's only financial institutions. That might be someone that is just like, okay, I'm gonna hire someone for whatever reason, but I will have to withhold taxes one way or the other. Now, here is where tax treaties are really important because it depends on whether we the US, have a treaty with the country, the country of residence of the taxpayer. That taxpayer might have already requested for a reduced rate. So per some tax treaties, instead of withholding 20% on dividends, there might be tax treaties that say like, okay, the US will withhold 10%, but they do have like, treaties need to be claimed. And this is something that in generally people do not know. Not because that there's a tax treaty, that means that it's gonna be applied automatically. Treaties need to be claimed by the taxpayer, right? What does that mean? It means like the taxpayer, in my practice means that the taxpayer sent Raymond James a W-8 requesting or claiming the treaty and letting us know that we should withhold a reduced rate. That makes it's a huge operational work. Imagine having to withhold millions of dollars in taxes, having to pay them to the IRS, make sure the IRS is receiving them, and issuing forms for each payment that we're doing. One copy to the IRS, one copy to the taxpayer. So it's a huge operation. And the IRS, of course, is not paying us to do that, to do their job. Okay. Let's go more like with individuals. Tax residency is not an immigration status. Many people confuse what your immigration status is with your tax status. You might be illegally in the US for immigration purposes, but still be considered to be a US taxpayer. And how does that work? Let's see. Usually you're a US person or for this purpose, a US taxpayer. You will have to pay taxes in the US if you're a legal permanent resident. That means like all green card holders. Their green card holders are taxed exactly the same way that US citizens are. Also, of course, if you're a US citizen, you're a US person for tax purposes. And also there's one thing called the substantial presence test. And this is very interesting. I'm sure you've seen like uh, artists, athletes going through like, okay, they spend this amount of time in the US, so now the US is going after them for their worldwide income. And that's a scenario that I'm sure you've seen, but also not only in the US. I'm sure that you have also seen this scenario in Spain, because Spain is very aggressive and it has like a very similar rule than the US with the substantial presence test. And what happens is the US says, if you spend over 183 days in the last 3 years, and there's like sub rules to that 183 days. The sub rules is 31 of those days need to be in this calendar year. The days that you spent in the year prior, the current one, are gonna be counted at 1/3, and the days that you spent in the year before that prior year are gonna be counted at 1/6 each day. But if in total they're over 183 days, you're gonna be considered a US person and you're gonna be taxing your worldwide income identically as a US citizen is taxed. So in my practice, how does this translate to my practice? Well, there's a lot of people, especially has happened to me, and I'm just talking about my practice, and this is just like how it has been. Like, I'm originally from Mexico, and there's a lot of Mexican people coming to the US because of safety reasons. And they buy a house in the US and they spend over 183 days. That happened a lot in COVID times. They were like, okay, well, I mean, I should not be saying this, but this is what was going on. They were like, oh, the US has like the COVID vaccine, so I'm just gonna go and stay in my house in La Jolla, in Coronado, in wherever, in the woodlands, in Houston, and I'm just gonna stay there. Well, yeah, you're gonna stay there, but now you're gonna be considered to be a US person and you're gonna be taxing your worldwide income. So all these people that are like they were from Mexico and they're businessmen that are originating their income from Mexico and paying taxes in Mexico now needed to report to the US. And that was really interesting. Because of other rules that I will also mention later on. So yeah, just spending over 183 days makes you a US taxpayer. And the reason why is that is the US says like, okay, well, you're spending most of the time in this country, you should be paying for that, right? Like, okay, yeah, you're like all these people from Mexico that I know, they were here staying because of safety reasons, because the health they were receiving like health benefits, and it's like, well, yeah, you're receiving all these benefits, then you have to pay taxes. So that's that with the substantial presence test. And then one thing that I do want to mention regarding the substantial presence test, and it's not like what makes you a US person, but it's just important, is like, okay, let's say that these people, same scenario, like there's a businessman from Mexico that spent over 183 days in the US, but all their income is being generated in Mexico, and they were just here because of COVID, and all their affiliations are in Mexico, their primary house is in Mexico, their family was in Mexico. You can claim the treaty, it's like Article 4, and you go to the treaty tiebreakers, because at that moment, the person becomes resident of both countries, of Mexico and the US, but because Mexico and the US have a tax treaty, they also have their tiebreaker rules, where you're like, okay, if at some point in your life you become a tax resident of both countries, we're not gonna, we both countries agree to not tax you twice, That's why the treaty is made. And there's gonna be tiebreaker rules, and depends on like where your closer connection is where you're gonna pay taxes. So in some of those scenarios where these people were like, I'm gonna call it overstaying in the US, we were able to claim the tax treaty and say like, okay, well, this person, all their affiliations, they vote, their affiliations are in Mexico, they vote in Mexico, their families in Mexico, all their incomes in Mexico, their primary residence is in Mexico, so they're just gonna be considered a resident of Mexico for tax purposes. That's why it's so important, tax treaties. Okay. Also, surprise number 3. 2 countries can tax the same income. I already mentioned like some scenarios where 2 countries would tax the same income. And let's say that one, this person was not a person from Mexico, but was a person from Venezuela. Right now, we don't have a tax treaty with Venezuela. So then that person would have become a resident of both countries. And if the source of income was in Venezuela, that person would have need to pay taxes in Venezuela, but also in the US. When that happens, usually what we look at is 2 things. One is the source of the income, where the income is coming from, especially if we're gonna claim the treaty. What we're gonna look at is where the source of the income is. And number 2, we're gonna look like where's your residence, where do you spend most of the time. One thing that I do want to mention here is like, okay, sometimes I want to mention 2 things that are really interesting. One is even if when there's no tax treaty with the US, another thing that the US has, and very little people know about this, is called the FTC, the Foreign Tax Credit. Usually, the IRS will let you at the federal level offset any taxes that you would owe in the US if the source of the income was in another country and you pay taxes in that other country. Then you're going to be able to claim the FTC, the Foreign Tax Credit, and it's a form 116. So that's one thing that people don't know. So the US is not that aggressive as we think it is. Like, yeah, you're being taxed on your worldwide income, but they're also understanding of some situations. So, for example, there's the FTC. Another thing that I can mention here, where the US shows like its understanding of certain situations, there's another thing that very little people know of. It's called the foreign earned income exclusion. And when a US person is residing in a different country than the US and obtaining their income in that other country and paying taxes in that other country, when they include the income, because they have to include their worldwide income in their tax return yearly, when they include their worldwide income, they can take something called the foreign earned income exclusion, which will reduce your taxable income in the US. So that's another thing and another tool that the US has for when there's like a resident of 2 countries, the US and one other country. Now, something really interesting that I do see in my practice is the same way that I'm telling you that we in Raymond James withhold taxes and have to pay those taxes of foreign people to the IRS. Sometimes US people, US citizens want to invest abroad. And it's the opposite way. Let's say that they're investing through Raymond James in shares of let's say, a French corporation, and the French corporation withholds the taxes, or we have to withhold the taxes, and we have to pay France for those taxes. But let's also say that the tax treaty, there could be a tax treaty that could be claimed, and then the taxpayer comes, like our client comes, and like, hey, I'm sorry, I did not claim it before. Then we have to, there's a whole process, and it's just like another world that is like, it's called like claims. So it's like requesting refunds, right, for taxes that should have not been paid. And requesting refunds is also, it's a lot of paperwork. That's something that I also see. And I also have to learn about like how other countries have different processes on requesting refunds and claims and all of that. So it's also really interesting in my practice to see that. That's also something that is like really international. Sometimes because the amounts are so large, I have to travel to that other country to file for the paperwork. And just like sometimes those other countries will, even the US, sometimes it's not like that easy to deal with. And then you do have to fight for your rights. And it's just something that it has made me travel. And it's just claiming for refunds. Okay, this is really interesting. There's one thing. Okay, 427, good. Water. There's several types of tax. I'm assuming you all know that, but there are several types of taxes. One tax is the income tax. A different tax that the US has is the estate and gift tax. Okay? And there's sometimes that for non-resident aliens means that it's like a person that is not a US citizen nor a US resident. Estate tax might be more important than the income tax itself. So for US taxpayers, for US citizens or legal permanent residents, there's a lifetime exemption of, right now, it's around $50 million, where you can, for the estate tax. So if I die and my assets, my estate is over $15 million or less than $15 million and I have children, I can, like, there's not going to be any estate tax because my estate is less than $15 million. That's if you're a US citizen. But that's not the same rule if you're a non-resident alien. If you're a non-resident alien, the lifetime exemption is $60,000. So after $60,000, the estate tax kicks in. So let's see an example. Let's say that there's, I'm just gonna say a Mexican person also because that's something that I see a lot here in the border. There's a Mexican person that comes and buys a property in San Diego. The property in San Diego is going to be, let's say, $500,000 at least in San Diego. That means like all these people that are coming from abroad and are buying, like, and this is something that you see a lot also in Florida, in Miami, like they just come and buy condos in Miami, in Texas, in Houston, Austin, here in California. Like foreign people come and buy property, but they're not aware of the estate tax. And they just buy the property because they can and they're allowed to, and it's their right to buy property. And the US welcomes foreign investment, and it's like, yes, foreign investment, come spend your money here. The US is very happy about you spending your money here. Yeah, but if you hold title to on that property through your personal name and you pass away, you're already dead, but there's gonna be a letter sent from the IRS saying like, sorry, your estate is taxable and you owe us 40% in estate taxes. The estate tax is a progressive tax rate, but it goes pretty quickly to 40%. So it's very, very high. And that's something that a lot of non-resident aliens do not know, and they're exposed all the time to this. I see like all the time. I don't know why it's my algorithm as a Latin person, but I do see like realtors all the time on Instagram, etc., like selling like or targeting to sell property to non-resident aliens. And I don't know, it's just like my heart aches for all those non-resident aliens that are not being informed that they're gonna be that they're exposing their estate at a 40% tax rate, like huge. It's like 50%. And maybe it was your like savings, and that's how you're buying your second home, and you're like really excited about buying your second home and leaving something to your children. And you're saying like, okay, yeah, I'm gonna buy this place and then my children will be able to use it. And no, like what happens usually is like children will have to sell it so they can pay the estate tax. And that's one of the things of my practice that I see every year. Every single year, there's a person calling me and saying, like, hello, my name is this. My father or my mother held a property in the US and it was not resident alien and they passed away. And now I got this letter from the IRS. Every single year, I see this scenario. There's ways of minimizing the exposure to that estate tax. That's something that I do see in my practice, how to structure the investments so people can come and buy and not be exposed to the estate tax. Okay, last rule, and then we can go to questions. This rule applies to, or like, because I'm talking a lot about inbound and outbound investment. This rule applies for US people that invest outside the United States, okay? So sometimes the tax is zero, but the reporting is not. But that the tax is zero, it's also like almost a little lie. Usually the tax is never zero, but okay, let's pretend that the tax is zero, but the reporting is not. Okay. When a US citizen goes and invests outside the United States, most likely than not, they're going to have a lot of reporting requirements under 1040, their tax return. Instead of being like 2 pages, it's going to become like 20 pages. And there's going to be a lot of forms. Okay, so I'm going to go through some of these forms. FR, that's not the official name. The official name is FinCEN 114, and it's not even reported directly to the IRS. It's reported directly with financial crimes. And it's commonly known as foreign bank account reporting. What does that mean? That when a US citizen or US person holds a foreign bank account outside the United States, or several bank accounts, and the aggregate in total the accounts have over $10,000, that person needs to report to the IRS and financial crimes that they have that foreign bank account. So let's say that there's this person, her name is Anne, and she has 10 bank accounts. Each of them has only $1,000, and all of them are in different parts of Europe. One is in Italy, Spain, Belgium, Portugal, whatever. It's 10 different bank accounts, 10 different countries. Each of them hold only $1,000. Well, because the aggregate value is over $10,000, and has the obligation of reporting the 10 bank accounts when she files her tax return. And she will have to report to the US and say like, hey, US, I have this other bank account in this country. This is the address of the bank. This is my bank account number. This was my highest balance of the year, etc. The penalty for not filing this form is $10,000 per year. And it used to be $10,000 per year per form. But recently there was a US Supreme Court case that said that it was going to be $10,000 per year. Then, for example, we have the 8938. Okay, I'm going to go through 8938 later. I'm going to just talk about 5471. Okay, 5471 is when a US person has shares in a CFC. Okay, when a US person has a company outside the United States, they might need to file 5471. Usually when that foreign corporation is owned 50% or more by US people, but that's usually, but I'm not going to go through the rules of the 5471 because I'm never going to end. But in general terms, if I want to go and open a construction company in the Emirates because, oh, the Emirates, there's no tax in the Emirates. I'm a US citizen now, happy to say that. So let's say like me, that I'm a US citizen now, I go and say like, I'm going to open a construction company in the Emirates, in Dubai, because there's no tax in the Emirates. So yeah, I'm going to do that. Well, no, I will have to report it to the IRS. I'm going to have to report the 5471. I'm going to have to tell the IRS, hey, I have this foreign company and this is what we do and this is our financial information and this was the income I got. And not only that, but 5471 also leads you to a different type of tax that is called GILTI tax. Now it changed names. Now it's not GILTI tax, but we're going to call it GILTI tax, GILTI. And it's pretty much a tax, and this is really interesting, a tax that taxes the undistributed profits of foreign companies that are mostly owned by US people. And why is that? The reason why it really comes, like why GILTI was enacted back in 2017, also by the Trump administration, it's because there were big companies, for example, Apple, where they had like most of their income was in Ireland, and Ireland was not distributing that income to the parent company in the US. So they would never be taxed in the US because the income was never coming to the US and the income was staying in Ireland. So the Trump administration came and said like, hey, this is not fair. That's your income. You can use it in any way that you want to do. So I'm going to, it's just in general terms because it's a formula and I'm not going to go through the formula, but in general terms, GILTI is just, it taxes the undistributed profits of CFCs. CFCs is a control for incorporation, and a control for corporation is usually that corporation that is owned 50% or more by US people. So you have 5471. If you do not file Form 5471, also the penalty is $10,000 per year. Form 5472 is very similar to 5471. And okay, the Form 8938, it's like a double reporting of the Form 5471 and the FBAR. And you just have to mention again what your foreign financial assets are. And we usually call it that is double reporting because you're already reporting what your foreign financial assets are by saying like, these are my foreign bank accounts and these are my foreign companies. But the IRS tells you like, oh, on top of those forms, we want the 8938, and I just call it that it's double reporting, and it's like a summary of the FBAR and the 5471 together. That's the Form 8938. Also, a penalty is $10,000 per year, or start at $10,000 per year. 5472 is similar to 5471, but it's like for foreign-owned U.S. corporations. And Form 3520 is also really interesting. So this is a really interesting rule also of my practice, and is, okay, if there's a U.S. person, a U.S. citizen or a legal permanent resident, and that U.S. person receives a gift from a foreign person, and that gift, it's outside the United States. So let's give a specific example. My parents are Mexican citizens only. They live in Mexico. Let's say that they want to gift me their house. They can give me their house, but I will have to inform to the IRS that my parents are foreign persons gave me a foreign asset, and that's reported through Form 3520. And the reason why is well, there's many reasons. One is, and there's not going to be taxes on it. So yeah, this is one of the scenarios where tax is zero, reporting is not zero. So I can receive like whatever amount from my parents, and it's not going to be taxable, and that's going to be great, right? But the IRS wants to know that gift is coming from licit sources, right? So it's just like, okay, Andrea, let's make sure that it's coming from your father's account. Let's see that, I mean, there's really no like payment of a service, and now you're just telling us that this payment of a service that should be being taxed is a gift. So that's the way that the U.S. says like, yeah, we welcome foreign investment. Tell everyone in your family, all of you foreign people, to send you all the money they want because you're going to spend it in the US, and we're not going to tax it. But we want to make sure that it comes from licit sources and that it's really a gift. and you're not just like calling it a gift when it's not a gift. And when the importance also of Form 3520 is later on, it's just going to give you a basis. You know what a tax basis is? Well, I'll explain. It's just going to give you a basis for when you want to sell that asset. So let's say that in the same scenario, my parents say like, Andrea, we're going to give you a house that it's here in Mexico, and the house is worth $1 million. So I'm going to report it in my Form 3520, and I'm going to tell the IRS, hey, IRS, my parents gifted me this house, and it's worth $1 million, and here is like the valuation or the appraisal, right? And why is this important that I'm reporting it? It's because if in 10 years I want to sell that house and I sell it for $2 million, also in that's my basis. My basis is going to be $1 million. That's what we call the tax basis. And the fair market value in 10 years, let's say that it's $2 million. So then the gain is only in the difference, right? So it's very important because it's the obligation of US taxpayers to do so, but also it's important to file it because it sets a basis to the IRS. Otherwise, the IRS, when you sell that asset, is going to say like, oh, no, your gain was on the whole amount, not only on the actual gain portion. I think that's all. Those are all the rules I had. Okay, yeah, those are all the rules I have for now. Um, why start international tax? Well, first of all, always say that tax is non-karmatic. I'm not putting anybody in jail. I'm not taking any children away. I'm not taking any husband or wife or anything. Um, it's just taxes, right? And I mean, it's taxes that, if you're a good tax attorney, it's taxes that should not be that you can minimize. You can minimize those taxes in a legal way. So it's non-karmatic, first of all. It's really interesting because you deal with clients from everywhere in the world. You talk to people from everywhere in the world. I talk from people from everywhere. I swear, Australia, Emirates, Middle East, Europe, Latin America, Canada, Asia. I talk to people from everywhere in the world, and I love that. At least me. There might be other people who say like I like to deal with a lot of different cultures. Uh, Usually, every jurisdiction will come into place, and every structure creates a new puzzle. Like there's so many scenarios; it's never the same. I also do tax controversy. I do audits, IRS audits. I do CTF audits, EDD audits. But it's always an audit. Is what it's it's the same thing. But international tax, I feel like it's always a different scenario. It challenges me a lot, and it's like evolving constantly. And it's also I like it. Maybe there's other people that won't like it, but it's also very politicized. Um, and there's organizations like the OECD that are like trying to impose like a minimum tax for all countries are part of the organization, and it just moves as politics and geopolitics move. So I enjoy it.
Thank you so much, Andrea. It was a really insightful conversation, especially to me. I'm not super related with tax, and I was like, this is a whole world, and I'm glad we did it on international tax. I see that we have some questions in the chat. Um, the first one is from Enrique Abelardo. He's asking what happens with the people who hold investment visa. They automatically become taxpayer in the US. How works that connection visa versus taxes?
It depends. There's investments visa that allow you to invest in the US. There's investment visa that will give you a legal permanent residency, a green card. So once that you have a green card, you're gonna be taxed exactly as a US citizen. But there's other that they just allow you to invest in the US, reside in the US. But again, the important is not, and there's visas like the student visa that will specifically tell you like for tax purposes you're not gonna become a US person even though you spend more than 183 days in the US. So yeah, there's visas that will like also tell you like you're not gonna become a US person. Usual investment visas do not have like the you're not gonna become a US person for tax purposes, but what they're gonna do is they're gonna remit you to the other rule that I was talking about, which is a substantial persons test or the legal permanent resident test. Are you a green card holder or are you spending over 183 days? Then you become a US taxpayer. That's usually how it works.
Okay, perfect. And then I see we have other two questions. The second one is from Carlos Manso. He's asking, for non-resident aliens, we understand U.S. asset gifts and state transfers above the 60K exemption are taxable, but who is the tax subject? The receiving party?
The estate, the estate itself. So you're like if someone that passes away and had a property in the US, that's their estate, right? And their estate will not be able to be transferred. Like children will not be able to claim title of that property until the estate tax is paid. So the estate is the one who's going to have the burden of the estate tax.
Perfect. And then we have a third question from Mercedes. Have you seen situations where a taxpayer needed it to prove residency to a foreign country but did not clearly qualify as a tax resident anywhere?
So it's a tax resident of nowhere, but needs to prove somewhere. I don't think I have ever seen that scenario where it's a tax resident of nowhere and still needs to prove something.
Okay.
No, I have not seen that scenario.
Okay, perfect. And then the last question is from Leonardo. He's saying, I'm a foreign person that received an IRS tax refund plus interest. Who is going to do the withholding for that interest income, and at what rate will that withholding be?
That's a very good question. I mean, the IRS should have withheld on that. So I guess that you got lucky, just enjoy your money. And that's what it is.
Okay, perfect. I think we don't have any more questions in the chat unless I think we have room for one more question.
And otherwise, if there was no withholding, you have the obligation of filing a 1040 non-resident and say like, I got interest and here's your payment.
Mhm.
Okay, sorry.
And the last question that I see here is what's a good source of study on international taxation?
I am looking away because, oh, okay. There's a book called A Guide to International Estate Planning. That's one of my favorite books. Let me see who it is. A Guide to International Estate Planning. And it just depends on like what are you looking to do? Because again, what I'm saying is just like there's so many things. But this is a book that I really like, and it's by Lay Alexandra Basha. Alexandra Basha, A Guide to International Estate Planning, Drafting Compliance and Administration Strategies. That's a book that I like.
Perfect. Thank you for sharing that. And then this recording will be uploaded to our YouTube platform, and I will be sharing that through social media. And then we have just one more last question before we wrap up the session, if that's okay with you, Andrea.
Yeah, of course.
If a foreign national has a trust in the United States and purchase a property through that trust, will they qualify for the 14 million state tax exemption, or will they still be subject to the 60,000 exception applicable to non-resident aliens for U.S. state tax purposes?
Based on the information that is being given, the rules, the estate tax will still kick at 60,000 based on the information that is being given.
Okay, perfect. So I think that's it. Thank you so much, Andrea, for taking the time to answer all of the questions from the chat. It was a very insightful conversation and I really enjoyed it. Before we wrap up the session, I wanted to share my screen as well. Here it is. Let me see. Let me know if you can see it. Is it
Yes,
projecting? Yes. Okay,
we
perfect.
can.
So as I mentioned, if you want to hear more about Andrea, she's an adjunct professor here at USD, so you can join her class. I believe she had class today. But I am the head of admissions here at our Office of Graduate Programs at USD Law. and I oversee admission for our degree programs. We currently have 6 LLMs and our Masters of Science in Legal Studies, which is kind of referred for a degree for non-lawyers. We just closed applications because classes already started for both of our online LLM in US Law, both in English and in Spanish, which will be the Maestría. This is a perfect pad and is specifically designed for international attorneys that want to gain a deeper understanding of the US legal system and might be trying to sit for the bar exam. Applications are going to be open closer to the fall for the next term, which will be summer 2027. So if you have any questions, you can scan the QR code here for my WhatsApp or email us directly, and I'm happy to schedule a meeting with you to discuss the admissions process. We also have the modality, the same program, LLM in US Law, but on campus. You can, on the modality on campus, choose a concentration such as tax. And our faculty includes some of the nation's top tax law scholars and practicing attorneys. And it's also one of the best programs here in California. So I really encourage you to explore either LLM in US Law with a concentration in tax or the LLM in tax itself. We still have some openings if you're a working professional or if you want to just take this course from your house, or if you have other things that won't allow you to be on campus. We have our LLM in tax online. And we still have some spots available. Classes will start August 17 in case you're interested in that. And then the following LLMs are for people who hold a JD from the US, which is the LLM in International Law, LLM in Business and Corporate Law, and the General LLM with a concentration. So I'll be happy to schedule a meeting with any one of you that might be interested in pursuing a career in tax. And hopefully we can schedule more tax webinars. You can let me know which topics you're interested in and I'll do my best. Andrea, thank you so much again for your time today. We really appreciate your clearly insights in this topic. And thank you everyone as well for taking the time to join this webinar. Have a great rest of your day.
Thank you. Bye-bye.
Thank you. Bye-bye.